We continue now looking at other types of money market investments. Next, we have what's known as an asset management account. This is an account that combines deposit accounts with a brokerage account into a single consolidated statement. So what we're saying here is that I'll just use Bank of America, who often teams up with Merrill Lynch. They may combine your deposit accounts with Bank of America along with your brokerage account, and they're going to manage those accounts all together. That is known as an asset management account. And how it works is that the asset management account sweeps any unused balance in the brokerage account into a money market investment at the end of each day. So they look at the amount of funds in the brokerage account, and if those funds have not been used, say, to attract or to secure other type of securities, then those funds are put into your money market account. So you can talk to your financial institution and ask them about an asset management account where, again, it's going to combine your brokerage account, your investments, along with your depository account, such as your checking account or your savings account. Now, you need to know about these different types of money market investments, their advantages, as well as their disadvantages. You can see them here on the screen. So I won't go through each one section by section, but you can just kind of see how with a basic checking account, yes, it's very liquid, but there's no interest. Compared to a money market fund account, which is liquid, but not as liquid as a checking account or a now account, sorry, but it will yield you a higher interest rate. Okay, so again, you want to use your funds to yield the highest return possible, but you have to make sure that you have enough funds available to take care of your operational needs. So there's always a balance between wanting to take my funds and invest them, but I also want to make sure that I have funds available to take care of my operational needs, to make sure that my cash outflows can be accommodated. So when you look at, again, a return, this is just showing you different type of investments, and as you go up, yes, the check account, of course, is the most liquid, but a 1-year CD will offer you the highest return on your investment. So once again, it's about managing your funds, right? Understanding what is needed now to take care of my operational expenses, my cash outflows, the amount that's not needed immediately. I can invest those funds in some type of money market investment that's going to yield me a higher return on my investment. Okay? Now, of course, you have to think about the risk and the risk management. So you're talking about credit risk or default risk, the risk that the borrower may not repay on a timely basis. Okay? So when you are borrowing money, they look at your credit risk or your default risk, the risk that the borrower may not repay on a timely basis. Depending upon that rate, that's going to impact the interest rate you're going to receive. Okay? Investment rate risk is the risk that the value of the investment could decline as a result of a change in interest rates. So all those different rates that I talked to you about, those different money markets I talked to you about previously, the investment rate risk is, again, the risk that the value of an investment could decline as a result. So if the interest rates lower, things of that nature, that's going to have an impact on the investment rate risk. And then you have what we call the liquidity risk, the potential loss that could occur as a result of converting an investment into cash. So here what we're saying is that if I take an investment from, say, a security and then cash it out, yes, it is liquidity, but now with that liquid cash, I'm not going to receive it as high return on that liquid cash as I was getting in that money market investment. So yes, it is liquid, but sometimes when I convert something into liquid, it also means that I'm going to get now a lower return on my investment. So CNN has a personal financial section that contains calculators that show you how to do all type of calculations on your finances. It can show you that if you were to invest so much money today, how much you have in the account over a certain time period. We covered some of these same topics in chapter 3, but CNN.com has a finance section that allows you to do scenarios so you can see if I was to invest so much money, what would be the potential outcome in the future. Now, there are economic conditions do have an impact on liquidity and the need for liquidity. So when the economy is weak economy can create liquidity problems, meaning that if I've lost my job, so right now we're in a pandemic, and for some individuals, they've lost their job. Some have been furloughed. Some are witnessing a decrease in hours being worked. When we have a weakened economy like we're facing right now, often the results is going to be a poor return on our investments. Okay? So this could be a time to allocate more funds to a liquid investment. So because again, if I'm working less hours or if I lost my job, I still have needs, right? So I may need to take my investment at that point in time, plus the return on those investments are going to be lower anyway. I may need to use those funds just to make sure that I can pay my mortgage, pay my rent, my car note. So when the economy is weakened, often that's the time we may convert our investments to a more of a liquid format. So typically when the economy is strong, we're going to have better job opportunities. Your income is more secure, less reliant on other sources to cover expenses. So that's when the economy is strong. We're in a good position. But when the economy is weak, there's a potential of job layoff, reduction in hours, income may be reduced. So at that point, we're relying upon other sources in order to make sure that our operational needs are being met. So yes, when things are good, strong economy, that's a better time for us to invest compared to when it's a weak economy. Yes, you can still invest, but you may need your funds to be more liquid to take care of your operational needs. Okay? So you need to ask yourself, where am I from an investment standpoint? Am I aggressive? Am I moderate? Am I conservative? So remember that you must consider the risk-return trade-off between these decisions. Yes, some investments give you a higher return, but they also offer a higher risk. So you want to take a look at that to see the trade-off. Now, most money market instruments are largely going to be free from credit risk, okay? Some money market funds do carry some credit risk since they may hold commercial paper. So if the fund manager has commercial paper included as part of that money market fund, there's some credit risk because the commercial paper is coming from actual corporations. And that means we have corporations involved, you will have some form of credit risk. Determining the optimal allocation of your money market investments. So once again, it's about anticipating your upcoming outflows, upcoming bills. And do I have adequate funds to take care of those items? Do I have enough in my checking account to take care of my upcoming bills? If the answer is yes, then any estimated additional funds needed in the near future and invest in a liquid. So if I know that, again, I have adequate funds to take care of my operational needs, my outflows going out, then I can take any excess and probably put that into some type of investment that's going to yield me a higher return. But if I know that there's going to be, I'm going to need additional funds in the near future, then my investment needs to be liquid so that I can access those funds in a short period of time. So use my remaining funds that will maximize your return, considering your risk tolerance. So again, the type of risk you're going to take depends upon how much of a risk taker you're willing to be. So yes, you can buy stocks and get a higher return, but acquiring stocks also comes with a higher risk. Okay? So interest rates right now on money market investments have been relatively low. They're low, but once again, there's not a lot of risk because those rates are pretty much guaranteed. Resist temptations are reducing these items in favor of stocks. So again, you may say, man, I can buy stocks and get a much higher return on my investment. Yes, you could, but remember this, you could also lose the entire investment by acquiring stock as well. All right? So with money market investments, again, they have a specific purpose to provide you with some return on your investment and also provides you with easy access to your funds. Remember that you're not going to lose the money that you put into a money market investment. Okay? So there's a website, the FDIC website, provides you with information on different type of investments, which ones are insured, which ones are not. So I recommend you go to the FDIC website and just look at the different type of investments to get a more clearer understanding on the different type of money market investments. Optimal allocations of money market investment. So here's a person first, net cash flows to a person who needs much liquidity. All right. So for this person, we're saying that their funds need to be liquid. If that's the case, we'll allocate most of their money to liquid funds to cover their anticipated expenses. If there's anything that's left over, then the other amount goes to non-liquid fund for more of a long-term investment. Compared to a person who needs a little liquidity, then most of their funds should go to a non-liquid fund for long-term investment, a smaller portion to liquid funds to cover their anticipated expenses. So again, look at your cash inflows compared to your cash outflows to see whether you will have a deficiency or a surplus. So a person who may have a deficiency, they're going to be in this category. If you have a surplus, you're going to be here in this category. So here are some key money management decisions for your financial plan. How can you ensure that you can pay your anticipated bills on time? How can you manage adequate liquidity in case you incur unanticipated expenses? How should you invest any remaining funds among money market investments? That's why we recommend you prepare a financial plan so that you know your cash inflows, so that you know your cash outflows, and that will help you to manage your money better. Okay? So let's say that we have someone who has a cash inflow of $2,500. Typically, their monthly expenses total $1,400. All expenses for clothing or recreation may total $600. So based upon this analysis, we have inflow of $2,500, outflows of $2,000. So we're saying that I will attempt to leave about $4 extra in a checking account because my expenses may vary from month to month. So we're saying that of that $2,500, we know that $1,400 goes to bills, that leaves with $1,100, but we want to keep an extra $400 in the account just because, again, our bills may fluctuate from month to month. So we may want to do something like require a CD for a short-term investment, maybe do a CD for 6 months or to a year, and use any of those excess funds to yield us a high return off of our investment. So the key is to be smart with your money, put a plan in place, understand what your cash outflows are, how much you have coming in, and if you have any excess funds, then use those funds for more of a long-term investment that's going to yield you a higher return. Okay? I hope this information has been very helpful for you. and we'll talk later. Have a good day.